in order to deepen public understanding of what went wrong, to inform the ongoing legislative debate about the need for financial reform, and to provide a foundation for building better defenses to protect Main Street from the excesses of Wall Street. Our first hearing dealt with the impact of high-risk mortgage lending and focused on a case study of Washington Mutual Bank known as WAMU, a thrift whose leaders embarked on a reckless strategy to pursue higher profits by emphasizing high-risk exotic loans. WAMU didn't just make loans that were likely to fail, creating hardship for borrowers and risk for the bank. It also built a conveyor belt that fed those toxic loans and mortgages into the financial system like a polluter dumping poison into a river. The poison came packaged in mortgage-backed securities that WAMU sold to get the enormous risk of those loans and their growing default rates off of its own books, dumping that risk into the financial system. Our second hearing examined how federal regulators saw what was going on but failed to rein in WAMU's reckless behavior. Regulation by the Office of Thrift Supervision that should have been conducted at arm's length was instead done arm in arm with WAMU. OTS failed to act on major shortcomings it observed, and it thwarted other agencies from stepping in. Our third hearing dealt with credit rating agencies, specifically case studies of Standard & Poor's and Moody's, the nation's two largest credit raters. While WAMU and other lenders dumped their bad loans into the river of commerce and regulators failed to stop their behavior, the credit rating agencies assured everyone that the poisoned water was safe to drink, slapping AAA ratings on bottles of high-risk financial products. The credit rating agencies operate with an inherent conflict of interest. Their revenue comes from the same firms whose products they are supposed to critically and objectively analyze. And those credit rating firms exert pressure on rating agencies, and those firms, the firms whose products the credit rating agencies are analyzing, exert pressure on the rating agencies who too often put market share ahead of analytical rigor. Today we will explore the role of investment banks in the development of the crisis. We focus on the activities during 2007 of Goldman Sachs, one of the oldest and most successful firms on Wall Street. Those activities contributed to the economic collapse that came full-blown the following year. Goldman Sachs and other investment banks, when acting properly, play an important role in our economy. They help channel the nation's wealth into productive activities that create jobs and make economic growth possible, bringing together investors and businesses and helping Americans save for retirement or a child's education. That's when investment banks act properly. But in looking at this crisis, it's not hard to echo the conclusion of another congressional committee, which found, quote, the results of the unregulated activities of the investment bankers were disastrous, close quote. That conclusion came in 1934 as the Senate looked into the reasons for the Great Depression, and the parallels are unmistakable to today's events.